Luke Holcomb has been in the industry for 20 years. He started as a contractor and now he specializes in helping construction companies fix their accounting practices to build more profitable, healthy businesses. Today, we're talking about how contractors should time hiring, equipment purchases, bidding decisions, all those things in a way that balances with the money that they have coming in. So, Luke, today I thought we'd start with how does a contractor go about determining the project volume that they need to break even every month just to hit they're not losing any money, they're not gaining any money. How do they calculate that break even point?
Yeah. So it's a funny thing. It's called a break-even analysis, right? In like accounting nerd speak, it would be your fixed costs divided by your contribution margin, and that would give you a number to shoot for. To make things really simple, if you take the reports that you have in front of you as a contractor, you have your profit and loss statement or income statement. That's like the most common one that we're familiar with. The top line number is going to be your income. That one's going to be important. I just put a little star by that. And I'll say like total income. Then you'll have a line that says gross profit. Put a star by that. That one's going to be important. And then you go down to the bottom and there's one called total expenses. And you want to put a star by that. It's going to be important. Now, as you're looking at these, it's important, and we've talked about this in an earlier video, but that you have transactions or costs or whatever in the right bucket, right? Because if it's not in the right bucket, then it's going to throw this whole calculation off. Like the total expenses really does need to be the total expenses, the cost of goods sold, or the gross profit needs to be what it is, right? And so income, just to go over that really briefly, what those things should be. The total income, that first thing we put a star by, it should be any earned income. Earned meaning that you've performed that work already. It shouldn't include any project deposits. It shouldn't include, anything like that. So if you've taken any deposits and you're in the process of working, completing that work, or you haven't started it, those should not be in there. It should only be completed work. When it goes down to gross profit, that's a calculation that your accounting software is making. And all it is what your total income is minus what we would call cost of goods sold. Simple language. That should be everything it costs you to actually build the project, right? So subcontractors, materials, equipment rental, any internal staff that are working on projects physically or, from an office point of view, but still very project directed, like project managers, things like that, superintendents. And that will give you your gross profit. And that's just how much money you made after you built the thing, right? It's how much you sold it for minus how much it cost you to build it. That's your gross profit. That's one of the things we have a star next to. Down at the bottom, we have the total expenses line. That's the last thing. And that really should just be anything associated with running your business that's outside of the actual building of the projects. And so that would be, vehicles, you can do sales commissions, you can do, office staff, payroll for whatever your payroll provider is costing, any software that the company uses, managers, general manager overhead, things like that. Any, overhead expenses, those are the costs of running the business. Those should be the total expenses number. So make sure you have the things in the right bucket for any of this to work. Or you'll come up with some, wild number and you'll start making decisions based on that number and it's not going to work out. So when you're doing this calculation, we talked about fixed cost was the first thing, right? So that would just be that total expenses line. And there's a bit of a caveat there. So it would be the total expenses, but that's not what you're trying to capture here is every month that goes by, how much cash does your business need, right? And so the total expenses will capture 99% of that. But if you're paying every time you pay a loan, the interest portion gets included in total expenses. But whatever you paid in principal in that loan payment is actually coming off the balance sheet. And so you need to add that back into the calculation. So you need to include whatever you're paying in principal every month. And then you also need to take into consideration if you're an owner and you take any money out of the business that's not associated with payroll. So sometimes, for larger construction companies, the owner will have a paycheck that's like a W-2, but then they'll also take a portion of their compensation just straight out of the business. That'd be considered like a disbursement or owner's draw. And so you need to add that in as well. That's another thing that happens on the balance sheet and equity. And you need to add those figures in. So you're taking that total expenses line, you're including any principal loan payments, and if you're paying yourself just straight out of the bank account, anything that has to do with that. That's going to be that fixed cost number. You're going to divide that by the next, nerd accounting word, contribution margin. And that just means your gross profit percentage, right? So you're taking that gross profit number that we put a star next to, it should be around the middle of that profit and loss statement. Divide that by the total income, that should be your gross profit percentage, right? And so for like a $10 million commercial contractor doing tenant improvements, let's say their annual revenue is $10 million, they're probably looking at a gross profit of about, 15%. So that means that there's $1.5 million is going to be that gross profit number. Take that divided by 10 million, you get 1.5 or 15 rather. And then their total expenses will, hopefully be less than 0.5 million because, you need money left over, but take that total expenses number, say it's $1 million. And that's what you're going to try to use, right? So you will take that $1 million plus whatever principal payments you're making, and then like whatever you're taking out as an owner for a draw, not through payroll. Let's say it's another $200,000. So now we're at 1.2 million. And so you take 1.2 million divided by 0.15. That will give you the number that you have to produce in a given year to break even, meaning to cover all of the things that all the cash the business is going to need. I'm using the word produce very specifically because, you do need to give these you need to consider these numbers when creating sales goals, but selling a project does not actually earn you that income. It doesn't put it in your bank. You need the money in your bank. You need to own the money. It needs to be your money. And that's why I say you need to actually produce the work, because selling the work isn't the same as producing the work. You need to actually produce that work to hit your break-even point.
Yeah. So what if a contractor doesn't know their gross profit margin? Like what if they haven't quite gotten job costing in place to a point where they're confident in it? What do they operate off of? Is there some benchmark number or some other way to estimate that gross profit margin?
Yeah, ideally it should be, how you're estimating things, right? So you should have an idea of how you're estimating, like what your target margin is when you're estimating. Or if you're doing cost plus work, you can use that figure. An important point to consider here is that if you are doing cost plus 20, that does not mean you have a 20% margin, right? Markup and margin are different things. It's important for contractors to know. And if you don't know the difference between those things, look it up, and don't feel bad. I've had clients who ran private equity companies and they got confused between markup and margin, and they started a construction company. They're trying to figure out why they're not making as much money as they are. It's like, well, let me see the math. They didn't know the difference between markup and margin. So don't feel like you're alone in that. Sometimes the funniest thing I ever heard was I explained that to someone and they called it the devil's math. I was like, all right, yeah, it feels like that, doesn't it?
So talk to me about, we have this break even formula. Tell me about how I use that then when I go to hire, let's say it's like a project manager for the company. I'm getting more business. I'm ready to hire a project manager. How do I use that break even formula in that situation?
Yeah. So project managers are unique, right? And it would be the same for superintendents, anything where they are going to be on the project, actually helping produce the project, because that's that, when we're looking at the buckets of what goes where, that cost to produce the project goes into cost of goods sold and comes out of, your gross profit, or your gross margin. No one shows up day one and either has all the work they need to keep them busy or can produce it perfectly efficiently, right? And so you need to kind of determine how long it's going to take them to get up to speed and kind of earn their keep for someone that's working in these projects, superintendent, project manager, something like that. And whatever that number is, you would want to, add that in just the same way that we added those like principal loan payments in that owner's draw to that equation of what is a fixed cost. I tend to look at this on a annual basis for a couple different reasons. One, it helps give, kind of the law of averages, right? So if you're trying to figure out what you need to do in a year, you're more likely to actually consider all the expenses that occur where you may have, some insurance payments, some things that are just like once a year, once a quarter payments. If you're just looking at 1 month, you're not capturing those. Or for owners, if you're giving bonuses to yourself at the end of the year, like you're not going to capture that if you're just looking at 1 month or anything like that. And so same thing when you're looking at this project manager, let's say it's a salary of $150,000. You think it's going to take them 3 months to get up to speed. That means you're putting a quarter of that $150,000 back into the number at the bottom.
Talk to me about how I then go from having my break-even point into creating my overall business budget for the year.
Yeah. So that break-even point gives you something to work backwards from, essentially, right? And so now, the big number that's important is what it's going to take you to break even by the end of the year or over the course of a year. And you need to consider that that's break even, right? That's not profitable. That's even, that's getting by. And so let's not set our goals on getting by. Let's set our goals a little higher. So let's say you want to profit so much, right? So you can add that also into the bottom of like how much you think you want your profit to be by the end of the year. You can add that in, just like we talked about adding principal, part of that project manager's salary, your pay as an owner. And let's add that in, profit in there as well. And that'll give you that big number to shoot for. And that should be what you're pushing your sales guys to hit over the course of a year. Right. And so when you're looking at budgeting, I like the EOS system, which is Entrepreneurial Operating System. If you haven't read that book as a construction owner, you should totally check it out because it kind of breaks down how you give ownership to the different roles and make sure everybody knows clearly what they're responsible for. So sales guys, they're clearly responsible for maintaining and achieving that top line number. That's their job. That's what they're supposed to be doing. Then you get down to that next, let's think in the buckets, the things we put stars next to on our profit and loss. So the next one is gross margin or gross profit. Well, that's the project manager's role to maintain that, right? And so he's trying to make sure that these projects are produced at the profit margin that they were sold at, right? So if you estimated sold it at a 15% margin, that's the role of the project manager to hit that number. Then you have the opportunity to say, hey, well, you can kind of break your project managers into cohorts, like who's doing well, who's not doing well. And you can have performance conversations if someone's really dragging the overall gross profit margin down because they're not performing. You can manage that as an owner. Same thing with the sales guys. If some people are pulling in, way more than everybody else, then okay, well that's, you need to compensate that person appropriately, and you can have performance conversations with people that are not hitting that number. And so then you get down to the bottom, that total expenses line. This one's going to be important too, because you started with a plan of what's going, what that total bucket is. And now this is more your job as the business owner, or if you have a controller or something like that in your company, this would be their role. But making sure that your business stays on track with that budget, just like you would, you think of like a home budget, like we're going to spend this much on groceries, this much on gas, this much on insurance, that you're managing to that budget that you used initially. Because if you go wild and crazy on spending, then it doesn't really matter what numbers you started out with because they don't match what numbers you're using now. So that gives you those kind of buckets and budgets for each of those different portions, and just kind of using what the outcome of the calculation, that break even number, and then going back and using, making sure you understand what numbers you use to get there and that you're managing to those numbers. So managing to a gross profit percentage, managing to an expenses budget for the year, that sort of thing.
Thanks so much for your time today, Luke.
Yeah, thank you.